Hello newbies, I'm super excited to see you here in Trading Basics Part 2 Lesson 4 Exchange Traded Funds. Before we start, I want to remind you to subscribe to our channels on YouTube, Instagram, and Facebook and leave your comments or questions. In the last lesson, we discussed short selling. And in here, we will explain to you what exchange traded funds are and how to use them. ETF stands for Exchange Traded Fund, and as the name suggests, they are simply a form of funds. Like any other funds, they are created by large financial institutions and then offered to the public. People can contribute money to it to make it bigger or take their money out to make it smaller. In essence, it's like a company stock when it comes to growth and decline, but you will not own part of that company when you buy ETF. Instead, you simply own part of the fund as a contributor. So what do these funds do? They track stocks, commodities such as gold and oil, indices such as S&P 500, Russell, and DJ. And what does this mean? It means if, for instance, oil price goes up, the fund will become richer, and if the price goes down, it will become smaller. They are very popular because there are ETFs for almost everything. So as long as you know an area of economy well, say for instance housing and real estate market, you can buy its ETF and wait for it to go up and make profit. ETFs can be classified into different groups depending on what they track. They could track indices such as S&P 500. They could track stock performance of a particular country or industry. We'll discuss these two groups separately. ETFs that tracks indices. I would like to focus on S&P 500 index because it's very popular. S&P 500 represents the average stock price of 500 US big companies from a variety of sectors. One good thing about S&P 500 is that if one sector is going down, the overall index may not be going down. For instance, if the technology sector is doing bad, the oil and retail sector can still be having a very good day. So their average will be positive even though technology is significantly underperforming. So if you buy an ETF that tracks S&P 500 performance, it's as if you are diversifying your portfolio in 500 big companies in the US. This is why ETFs are so popular. Some ETFs track the performance of a particular country's stocks. For example, if you believe Turkey's economy is booming, you can buy one of the Vanguard series ETF that invests in a few big Turkish companies, which make up the majority of the market capital of Turkish stock market. To find such ETFs, simply type Turkey stock market, and Google will do the rest of the job for you. You can find many ETFs this way that track this country's economy and stock market performance. Other ETFs track the performance of an entire industry sector. For example, if you're interested in real estate market in the US, you can search for US real estate ETF. You will find many options such as VNQ, which is considered to be one of the best bets for most novice investors to stay focused on the US real estate and buy into the largest public companies. VNQ is actually at the top of the list because it has a broad and diversified coverage when it comes to real estate markets. This way, basically, you don't need to actually buy a house. You can simply buy the ETFs that track the performance of the real estate and enjoy the profit. ETFs are very easy to trade. You can buy-sell them similar to buy-selling stocks. Basically, you can find the ticker symbol and trade them. You can buy options that are contracted on ETFs similar to stocks. There are future contracts that are written for ETFs similar to stock, and you can pay the same commission upon trading in most cases. You will pay a very small fee for passive fund management, which is still much cheaper than mutual funds that are actively managed by fund managers that may or may not be good at their jobs. Another great thing about ETFs is the fact that you don't need to short sell ETFs and borrow anything in the process. you can simply buy inverse ETFs. Inverse ETFs are made by using various means in order to profit from a decline in the value of an asset that ETF is tracking. Let's say in October 1st, 2007, you think that the tech bubble is about to burst. You can buy the inverse tech ETF with the ticker PSQ that shorts tech stocks, and then simply step aside and watch the tech giants tumble down while you actually make money. There are all kinds of inverse ETFs that allows you to short an entire sector, indices, or groups of stocks without actually short selling any of them. They're like other stocks and ETFs, with the difference that once the value of the underlying asset goes down, these ETFs' price goes up. Another important form of ETFs is called leveraged ETFs. Leveraged ETFs attempts to achieve returns that are more sensitive to market movements. A leveraged bull ETF fund might, for example, attempt to achieve daily returns that are 2 times or 3 times more pronounced than the movement of the security they are following. This is good if you are confident about an upward or downward movement of a particular security and you want to make more profit. Say, for instance, S&P 500 goes up by $2. If you buy a 3 times leveraged ETF, your ETF will actually appreciate by $6. Needless to say, it has its own inherent risks if your prediction ends up being wrong. Also, as usual, there are all kinds of leveraged ETFs out there. They usually don't go further than 3 times leveraged ETFs. That is, there are 2 times or 3 times ETFs in the form of short and long positions. As I mentioned at the beginning of the lecture, there are all kinds of ETFs out there that track many different items that you can imagine. For instance, there are commodity ETFs invest in commodities such as precious metals, agriculture foods, products, or hydrocarbons including oil and gas. You can make money by simply buying direct or inverse ETFs that track gold, silver, oil, wheat, gas prices. The next thing is bond ETFs, which thrive during economic recessions because investors pull their money out of the stock market and into bonds. For example, government treasury bonds are those issued by companies regarded as financially stable. There are even currency ETFs that track euro, dollar, Swiss franc, and currency ratio such as euro to USD or other forms of currencies. Obviously, you can open short and long positions to buy the inverse or direct ETFs. There are a few market newbie favorites that we want to recommend. These ETFs include technology such as QQQ and its inverse PSQ, oil such as UWT, natural gas such as UGAS or UGAS, real estate such as VNQ that we mentioned, gold such as GLD, S&P 500 such as SPY, retail including XRT, and Australia economy such as VGS and EWA. Coming up next, we'll talk about dividend and its advantage. Thank you again for watching this video. If you want to find more educational materials, visit www.marketnewbie.com, our Facebook and Instagram page. Again, feel free to leave any comments or questions and we'll get back to you as soon as we can. See you in lesson number 5.